Good afternoon. Welcome to today's webinar from CIC Services. What is alternative risk transfer, also known as ART, and why is it SmART? I'm Randy Sadler. I'll be your host today. I'm also joined by Chris Gallo. Chris, I'll let you introduce yourself very quickly.
Yes, Christopher Gallo, just retired after a 35 regulatory career with the Connecticut Insurance Department, joined CIC Services December 1st, and happy to be here.
Awesome. So Chris and I will tag team today's webinar. As we begin, we'll ask if you would keep your computer or your phone on mute. Unless you're asking a question, that would be great. We do have a little chat box if you want to type something into the chat as well. And we'll also have time. We'll take some questions during the webinar today, but we'll also take them at the end. We'll also be glad to send you the slides if you'd like them. So don't panic. We'll be glad to send them to you. And with that, let's dive in. First of all, I'm joined by Chris Gallo. As he mentioned, Chris spent 35 years in the Connecticut Department of Insurance, has a tremendous background in finance, regulated insurance companies, and then regulated captives. And we're thrilled to have him on board here at CIC Services. And I'll be your host today, Randy Sadler. I'm a principal here at CIC Services, and I have been here 9 years. I started my career in risk management really in the Army. I went to West Point and was a tank commander. And so for 5 years, had responsibility for soldiers, equipment, ammunition, fuel. As you can imagine, safety was always top priority. It's really where I learned risk management. And since that time, I've transitioned through many corporate roles, and I've now been at CIC Services for 9 years. Tell you a little, before we dive into the meat of our stuff today, I will tell you a little bit about CIC Services. We are a captive manager, which means we help middle market businesses set up and own their own insurance company. There's a lot of reasons to own an insurance company. Today, we're going to really focus in on this concept of alternative risk transfer and why it's SmART. We've been doing this since 2005, as I mentioned. And our principals really have about 2 centuries of experience. This says a century, but it's really, we're approaching 2 now of experience in the insurance industry. And we're going to interrupt our regularly scheduled webinar for a special announcement. Many of you may know this, some of you may not, but the Supreme Court ruled in our favor 9-0 against the Internal Revenue Service and their unlawful notice 2016-66. This is a huge win for the captive insurance industry. It's a huge win really for any middle market business that has found itself abused by IRS overreach. And so we're very pleased with this ruling. I've got a link here that you can go read about it more on our website. And certainly I suspect that our next webinar will be about the case. But again, this is just a fantastic win for our firm, the industry, many who supported our lawsuit, including captive insurance associations, CIC, Minnesota School of Law, Harvard Law School, the U.S. Chamber of Commerce, Cato Institute, and I'm sure I've left some out, but it's very exciting for us here at CIC Services. All right, now back to our regularly scheduled programming. About CIC Services. So we help businesses own their own insurance company. So Chris, what are some reasons that businesses might want to own their own insurance company?
Well, what I always found in my 35 years as a regulator is there's cash flow and liquidity, how crucial it is. So one of the things I've noticed, I've seen multi-billion-dollar companies fail because they did not have good cash liquidity and cash flow. So forming a second company like a captive insurance company, we found is a financial weapon which really helps an insurance company, a business owner, control their insurance costs, thereby increasing their cash flow and the liquidity. So we know every single company out there can always benefit by having additional liquidity and cash flow.
Very good, very good. Yeah, those are excellent points. And so in a little bit more specific language, we help businesses establish asset protected loss reserves, often shield from the parent business and creditors, increase the profit of the total business enterprise, that would be the business and their insurance company combined, and often by millions of dollars over time. Powerful way to lower and control insurance costs. And that's something that we'll really stress as we get into the idea of alternative risk transfer today, is controlling those commercial insurance costs, or total cost of managing risk. Ability to insure uninsured, underinsured risks. COVID is a classic. And then, insurance companies do have, beneficial tax treatment. That's always another nice reason to own an insurance company. So let's start by talking about what is a captive insurance company. Well, a captive is a real insurance company. It has policies, policyholders' claims, anything that, say, State Farm might have. Captives typically have a limited license, meaning that they can insure the business or related businesses. The definition of related often can stretch pretty far to, warranty holders or franchisees and associations. So it may not be as limiting as it sounds. And in many cases, they're not admitted or rated, so they may not be able to write work comp or auto liability, or things that require that type of rating right out of the gate. They have been around since the 1950s, so they're not new, and they insure businesses in about every sector of the market. So Chris, what are some things captive insurance companies do?
I know the first bullet point says replace commercial insurance, which does have the ability to do, but also works in conjunction with the commercial insurance market. You'll find that a lot of times commercial policies have exclusionary language. So for example, I tell people a lot of times, they might have heard the story about the husband and wife team that own a department store in Portland, Oregon, whereby during one of the riots, people broke in and stole all their merchandise. They had theft insurance from a commercial market, but unfortunately, there was an exclusionary language stated that if there's any theft during a riot, that the insurance company did not have to pay. So by forming a captive, it's almost like we could put in language with their policies that say, listen, if the commercial market doesn't pay, if there's a riot and people break into your store, we could pay you from your policy language in the captive, whereby it will pay in the case of a riot. Also, there are risks that are either uninsured or underinsured. I just mentioned that theft that occurs during a riot. You can insure warranties, bonds, any type of employee benefits and healthcare, or any combination of the above. So we feel as if that captives can do everything that the commercial market can do, and it can plug many of the holes.
Very good points. Yes, absolutely. And in simple terms, a captive really just follows this diagram, where the business owner or owners own their business or businesses, also own their insurance company, pay premiums and transfer risk to their insurance company, which in turn issues insurance policies. This is a really simple layout, and we'll go into some more complex layouts here in a couple slides. So let's talk about understanding captives and alternative risk transfer. So alternative risk transfer, according to AM Best, is a market that is growing. And what that means is that more and more, especially in the commercial market or in the business sectors, are doing some form of alternative risk transfer versus the guaranteed cost market. In fact, we're now at a point where 56% of insurance is purchased in some form of alternative risk transfer vehicle, which we'll cover. And Forbes basically indicates 90% of the Fortune 500 utilize alternative risk transfer programs. So this is a growing trend, and we expect it to continue to grow. And Chris, you and I were kind of talking the other day, I think, about alternative risk transfer and maybe the smallest known captive. What were you telling me about from a story standpoint?
The smallest known captive?
Yeah, it's a health savings. Yeah.
Oh yeah. The health savings account. That's right. So like the health savings account is a form of an alternative risk transfer, whereby the business owner or an individual person, employee, can put money into an account. And that's kind of like a small little version of what captives are. But instead of it being an individual having a health savings account, you could have a business owner putting money in to insure risks that can impact his enterprise in any way, shape, or form.
Right. So the business in a health savings account isn't an insurance company, but nevertheless, the participant is able to participate in their own risk. They get rewarded for good behavior, right? If they stay healthy and don't get sick and get regular physicals, and then they're able to keep money that would have just been gone. Very good point. So that's the alternative risk transfer market. And then we think about alternative risk transfer. There's we're calling it sophistication of risk. You may have a term you prefer better, but let's just go with that for now. So on the left side, we're plotting the amount of risk that a business is willing to take. And on the bottom, we're really laying out the financial reward. So in the bottom left, we've got the guaranteed cost market of just a complete transfer of risk, and all that money's gone if there's no losses. As we move up the continuum, you see high deductible or a self-insured retention, assuming some risk in exchange for a reduced price on the premiums. In the middle here, single parent captive, so a captive insurance company. That is assuming more risk under state or a domicile's oversight, so it is a regulated entity. Further up the chain, we get into even more, taking on more risk and potentially more reward with the risk retention group. And then up in the far right corner, a self-insured trust. So you can kind of see this continuum, if you will. And today we're actually going to focus on, because we're talking about alternative risk transfer, we're going to focus on these two: a high deductible program, and of course we're going to insure that in a captive, or we're talking about single parent captives as well. We like single parent captives because the business owner owns the insurance company. It gives them and the CFO tremendous discretion as well with the funds inside.
And Randy, a big difference.
Yeah.
We go one slide, please.
Yeah.
So the big difference between that high deductible self-insured retention, if a business owner wants to have that high deductible and he's just going to pay it out of pocket, he loses very favorable tax incentives, whereby you can put that same deductible into a single parent captive, whereby the business owner will deposit the amount of premium into the single parent captive. And whether the loss occurs or not, he is able to take that tax write-off, as compared to just doing the high deductible and not putting it into a captive insurance company. So you really want to take advantage of those positive tax consequences that Congress has laid out for us.
Very good points. So as we think about a captive, we talked about what a captive is. Now let's talk about operating a captive. It is a real insurance company, and it is subject to regulatory oversight, right? Large insurers are certainly overseen with more scrutiny. Captive insurance companies are still regulated by the same standards. And so states license insurance companies. They can also be licensed offshore. And they're regulated to make sure that they're solvent and that they are doing what an insurance company is supposed to be doing. And then the huge benefit of captives is that premiums that are paid and not paid out in claims or expenses are retained as profit and accumulate. So they can accumulate significant reserves in the captive for future losses. And in operating a captive, no surprise, there are some important steps. And this is where us as a captive manager, where we step in, and that's working with the regulator on behalf of the insurance company, coordinating legal counsel as necessary, whether it's in formation or drafting policies or unique policies, working with actuaries and coordinating their work to price the insurance. The actuaries also play a huge role in development of the business plan as well, and the pro formas. Working with claims, operations, tax and audit, which all insurance companies have. And then the asset management inside of the insurance company as the captive accumulates reserves. And then, of course, underwriting and really identifying appropriate risks, the appropriate level of insurance, and making sure that the insurance is fitting for the business situation. And captives are used widely. So this chart is from the 15th CIC captive market study, but you can see here a wide range of industries utilize captives. I'm often asked, what industries are captives good for? And the better way to think about a captive is, if you have real risk and you're spending a lot of money on your insurance, then a captive can be a fantastic fit. If you want to control that risk and take some of that risk on your own for the reward of the profits that you would keep. Very good. So now we're going to really dig into program design and structure of captives. And in the first couple slides, we talked about how often with a captive you can replace your commercial insurance, but rarely ever for a middle-sized business do you ever completely replace it. And the way to think about captives usually is that we're going to do some type of risk layering, as you see here. And so what you'll notice here is that the captive insurance company is taking a per occurrence layer, in this case of $250,000. There's nothing magic about that number. It could be 50, it could be 100, it could be 500. But so any loss that hits 250, the captive is going to pick up. And then over here on the right, you see $1 million aggregate limit. So this is a total combined exposure the insurance company is taking. And beyond that, we're passing the risk on to a rated reinsurance carrier. Could be a $2 million aggregate, could be higher. We've got some programs that go much higher. And here we're showing $1 million limit, but it could be 5, 10, 50. There's no cap here, if you will. It's really what the reinsurance carrier is willing to pick up. And so when we think about captive programs, it's really all about the creative layering of risk, how much risk the business owner or owners are willing to take in that captive. And obviously they're doing so for the goal of controlling the cost of insurance and the goal of reaping the reward of having profit left in the insurance company. Okay. So captive program operations. Well, what happens in the process of running an insurance company? Well, first, when we form a captive, it functions very much like any other insurance company. Policies are issued and premiums are paid in exchange for those policies, right? Solvency reserves are set. This is determined by the actuary, overseen by the regulator to make sure that they're legitimate, that there's enough money there for claims. In the event of losses, claims are paid. And then there's a cost to run the insurance company. Operations are paid. Really, the money that's left can be invested and grown, and then profits are realized. And again, we'll be glad to send you these slides that may be helpful as you think about captives and where they may be a fit for you or for your clients. So now, as you think about alternative risk transfer, we'd like to share a few structures with you, largely so you can think about how a captive can be a real solution for either your business or maybe some businesses that you're advising right now. And so the first thing we're going to talk about is what's known as a traditional fronted reinsured structure. And let's start by noting, what is fronting? Well, it's what it sounds like. It's basically what we put in front of the captive, right? So fronting is a rated carrier normally. They're often rated and they're often admitted in the states where we are writing insurance. So to write, for example, auto liability, a state may require that it be admitted in the state. And so the front will, in a sense, put their name on the insurance policy, issue the policy, and then reinsure all or a portion of the risk to the captive. Now, very often that fronting carrier is going to require some things to do that. They're often going to require reinsurance on the back end, right? They don't want to have their name on a program that goes bankrupt or can't pay its claims. And so they're going to ask very often to have a commercial reinsurer step in at some point and pick up excess. They'll often ask for collateral as well and require it. So those structures need to be in place. So you get this sense, if you will, of a sort of a sandwich: the front, the captive, the reinsurer. And so if the business is able to control their losses, in the middle of the sandwich, then they get to keep all of it. That's one way to think about it.
And Randy?
Yes.
A little bit of color about the minimum thresholds, like premium thresholds, just so our listeners know. For like a casualty multiple line premium, we're looking at equal to or greater than $2 million. And say for a single casualty line, we would need like a minimum of $1 million. And some of those casualty multi-lines would be general liability, workers' compensation, professional liability, directors and officers, umbrella, etc. And Randy stated, a captive really works well for those types of businesses that really have good risk mitigation strategies, and they have low loss ratios, therefore allowing right now the private carrier to get the profit. But if a business owner has good risk mitigation strategies and premiums with those meet those thresholds, a captive would really make sense for you, the business owner.
Very, very good point. So unfronted and reinsured captives, those are the targets that you should be looking for a captive program. And we're going to go through some other structures that actually will work for smaller, premium amounts as well. Let's go through those. But first, let's focus on fronting reinsurance. I've described it here, but let's also look at it visually. So here we have just a simple illustration of a traditional fronted reinsured captive. We have the business owners who own their business or businesses, pays premiums and transfers risk to a rated admitted front that issues the insurance policies, right? Satisfies what requirements they have, whether it's the state, whether it's a bank that's requiring property for the mortgage that they're providing, et cetera, right? And so this rated admitted front transfers premiums and risk to the captive, and the captive in turn likely will transfer some to a commercial reinsurer, and then you can see insurance policies flowing back here. And as an example, here's an example of a business that buys $3 million of insurance across multiple lines. Let's say property, general liability, work comp, perhaps auto liability, inland marine. And so what they're doing here is they're paying that $3 million to a rated admitted front instead. The front in this case we're showing is really transferring all the risk. They're taking $275 to issue the paper. They're transferring $2.75 million to the captive. The captive is in turn transferring $0.75 million to buy a reinsurance policy for the really big losses, leaving roughly $2 million in the captive. If the captive is able to operate well, then if they can keep their losses down, then that's all profit. And here's kind of a simple pro forma of what that might look like. Premiums of $3 million, fronting of $250, reinsurance of $750. In this case, we're showing a 5% cost to run the captive. Could be a little higher, could be a little lower, just depends on the complexity. The claims that actually impact the captive, for our case, let's assume it's $1 million out of the two, leaving an underwriting profit of $850. And that underwriting profit would carry over into the next year, giving the business more flexibility in its insurance. All right, let's talk about, I mentioned we would have a solution that actually helps businesses at a lower threshold, and that is a bundled captive insurance company program. So remember, we had a fronted and a reinsurance arrangement before. Here we're going to achieve essentially the same thing, but we're going to do it with one less step, if you will. So in a bundle program, we've got the shareholder owns the business and the captive. But you'll notice we don't have a reinsurance carrier here, and that's because the commercial carrier is actually willing to front and reinsure the program. Not exactly like that, but that's essentially what they're doing. So our commercial carrier is going to have a rated, let's just say A or A plus rated insurance. They are admitted, they match the limits, the terms, the cost that the insurance that the company's insurance was already providing, but they're willing to reinsure some of that risk to a captive owned by the business owner. And so you see here a transfer of premiums and risk to the captive. The captive issues a policy, and in this case, or most cases, the captive is going to pick up the low level losses. So if there's a $30,000, $40,000, $50,000 loss, the commercial insurance company is going to pay. Then they're going to file a claim on this captive, right? And so only if the loss goes over an agreed upon limit, might be 100,000, might be 200, 250, what we call an attach point. Then the captive is going to pay up to that limit, and then the commercial insurance company will pick up all the rest. And so this actually works for smaller premium thresholds. Chris, what are the thresholds on this program?
Well, I think those can go down as low as, say, $1 million in combined.
Okay, $1 million combined, and on a mono line, it can go as low as 250 to 300, depending. Very good points. Yeah, so here we're showing in our bundle program, and these are actual numbers from one of our clients, by the way. mostly general liability. They were paying $700,000 in general liability, and they had gone 5 years with no losses. So they're in the bundle program. They're getting that A+ rated insurance, matching limits, terms, and costs, satisfies the municipalities where they do construction, and they're able to reinsure $350 to their own captive insurance company, right? So think about that, premiums of $700, and then $350 back to their captive. Let's assume they had claims. Now, remember, we were saying that they've gone 5 years with no claims, but let's just assume they have $100,000 of losses, $40,000 of captive administration, and the underwriting profit in the captive, $210,000. So they've essentially, on $100,000 of loss, they've created $210 out of thin air that they wouldn't have had, that carries over to the next year in their insurance company's underwriting profit. And if you think about it, if they don't have the $100,000 loss that we made up here, if they continue to have that great loss history, they actually roll 310 over to the next year. So very powerful. All right, and that brings us to really another form of alternative risk transfer, and that is when businesses aren't large enough for a bundle captive, aren't large enough for a fronted reinsured captive, and is really to take high deductibles and let the captive pick up those layers. Remember, we said at the outset that the key to alternative risk transfer, in most cases, especially in the middle market, is layering of how the risk is going to be shared. So our diagram here is a little different. We have the business owner here and their business or businesses, and we've got their captive insurance company, but note that we've got the commercial insurance company, and then rated and admitted if required. But that commercial insurance company, I'm showing it stacked on top of the captive, and really all that's meant to do is visually illustrate that there's a high deductible. The captive is picking up that deductible. So the business is paying premiums, transferring the deductible risk to the captive, and in turn, the captive is issuing insurance policies for the deductible. And so you might say, why would I put a captive insurance company? Let's say I took $100,000 deductible. Why wouldn't I just take my chances on that, right? I mean, if they don't have a loss, then I didn't have to pay. Well, the reason is because in our structure, this captive is actually going to be reinsured. So that makes it easier to take a higher deductible layer, especially if you have a year where maybe you hit the deductible twice, right? Or 3 times. So you'll notice here we've got the business owner, the business, the captive, and a reinsurance pooling structure. Our pooling structure has 100 captives in it, and they share essentially 50% of the risk. Actually, 51 goes to the pool, and 49 is retained by the captive. But let's think about, what does that look like? So it looks kind of like this, all these captives sharing risk in a pooling structure, reinsuring all the captives. And so let's think about, if you had a high deductible, in this case, we're saying a $400,000 deductible, that's really high. Although we're working with a client right now that has a $500,000 deductible on property. So this is not too far out there, but $400,000, and they had a $400,000 loss, they would eat all of it, right? And it hasn't even hit the carrier yet. What happens? Have they destroyed some of their wealth? Maybe they lay off employees, as an example. But in a pooled structure like we have, half that deductible loss gets shared with the pool. So you'll notice here that $400,000 loss occurs. Third-party administrator verifies that it was legitimate loss, that their deductible reimbursement policy covers it. The captive pays $400,000. The risk pool pays half, really making the pain of that high deductible strategy much, much lower. So you can see here what a fantastic structure this is as an alternative risk transfer mechanism. So I told you we would talk about what alternative risk transfer is and why it's smart, right? And so here's just a quick summary of the things that we covered today that make alternative risk transfer smart. First, retaining a portion of profits that carriers normally earn. So Chris talked about the importance of cash flow and liquidity. One of the things that takes cash out of the business is buying insurance, and it is a must. So Trust me, we're not down on insurance, but if a business is willing to take some of the risk and able to keep some of the profit, that can really pay off over time. The second thing, captives aren't for poorly run businesses, but businesses that have sound management, sound loss control practices in place, they're able to be rewarded for those good practices. The third is controlling insurance costs, because as the captive takes on some risk, whether it's in a fronted reinsured arrangement, whether it's in a bundled arrangement or a deductible reimbursement arrangement, it helps control the cost of insurance paid to third parties, but it can also help smooth rate increases, and we've seen that as well. One of the things we often hear is that I was really mad at our carrier about how they handled our claim. So very often we hear stories about, I had video camera of a person walking around behind the aisle, watch them fake a dive, and then the insurance company wanted to settle, and then they wanted to raise my rates, right? Which infuriates business owners, no surprise. And on the flip side, I've talked with business owners that said the insurance company should have settled. They decided to fight it. They lost. It gave me a bad reputation in the news, and then they raised my rates again. So very often a captive does give the ability to exercise more control over claims at that bottom layer, which is a really, really big deal. Chris, you were going to say something?
Well, I was going to say, like, the control of the insurance costs. As you build up your assets, we've seen companies like right now, umbrella coverage is skyrocketing. So the more you get yourself in financial strength, you build up your own insurance company, you build up those assets, and then you could say, all of a sudden, if an insurance company is going to start increasing the rates, you can say, hey, you know what, I'll move some of that more inside, internally to my own captive insurance company. So again, the more control you have over all facets of your industry, the better off you will be.
Yeah, very good points. Very good points. Yeah, a captive also can give a business a negotiating tool to really work with their carrier and push, whether it's a willingness to take more risk in the captive, or in some cases just take all the risk. We have a client, and I showed you the pool structure. They'd have $1 million of general liability written direct to their captive without commercial insurance. That's a little bit extreme because if they have $1 million loss, they're going to be paying half, and the pool's going to pay half. But they work hard on loss controls, and they reached a point because the cost to insure their business was so high, they decided to insure it all in the captive and really bear down on it. So it can be a negotiating tool as well, very powerful. And one of the things I'm often asked, when should I start a captive? Really, if you can start one now, it often makes sense because it's only going to get stronger over time. And you'll have a much better negotiating tool when it's got 3 years of reserves in it than trying to start it from scratch when your back's against the wall. That's definitely something to consider. And the final benefit, Chris really talked about this early on, is a captive can be a CFO's war chest, for lack of a better term. Once that insurance company builds up excess reserves, some of those reserves can be released back as dividends. We've even seen captives that, because they built up so much money, they sort of function like a bank for the business. We're able to loan money to the business, in fact. So it can be a really good war chest for the company. All right, very good. That really concludes what we plan to cover today on what is alternative risk transfer, why is it SmART? If you have any questions, you could certainly unmute and ask them, or if you'd like to type them into the chat bar, please do so. Chris and I'll be happy to field any questions you might have. If you'd like the slides, send either Chris or me an email as well, and we'll get them to you.
Hello, Randy. This is Casey. Can you hear me?
Yes. Hi, Casey. How's it going?
I'm doing great. Listen, that was a great presentation as always. It seems like the deductible buyback would be a great way to ease in. Could a business owner add several lines to the deductible buyback, including their health insurance costs?
Absolutely.
Go ahead, Chris. Yep.
Yes, we've had, when I was a regulator in the state of Connecticut, we had companies who would form the captive for their health insurance deductibles. So absolutely. So any line of risk where you're paying a premium, you can put that a deductible layer in the captive. And health insurance is utilized often in captive.
That helpful, Casey? Uh-huh.
Yeah, it's very helpful. I have a client that has very high GL losses, and they have Section 8 housing that it produces
Right.
a tremendous amount of assault and battery losses every year, which they're self-insuring.
Right.
It seems like that would be a good way to put that in the that form of captive as well. Just that one exposure inside of their GL, which is, you know, basically uninsurable. So they're self-insured for that.
Yeah, we certainly look at that and see what is a layering structure that makes sense. It might be that they have a deductible and then the captive where it's pooled, and then commercial, right? So you might have 3 layers there. But we'd be glad to look at that one. Absolutely.
Okay.
Very good. Any other questions? Outstanding. Well, if you'd like a copy of our slides, let me know. If Chris and I can help you in any way, we'll be happy to have a call, webinar, and we'd be honored to work with you. And hope you guys have a fantastic rest of your day.
Thank you, Randy.
All right. Bye-bye.